Hello everyone, welcome back to my channel, hope you're doing well. Last week I released a video called Stocks I'm Ready to Buy Now with Ex Dividend next week. And I want to do a second video on this but a week later so we can go over the stocks for next week that I think are at a good value, and the one that stands out to me is MRK or Merck. So I will go over my fair value, what my buy price for the stock would be, and what I see the long-term future values being. But to introduce the stock to you, I think this article is a really good place to start. It's 5 dividend stocks to buy and hold forever, which is obviously the perfect what you want. It's just something easy management, buy it, leave it in there and hope that you can come back to it in 5 years and you made a great return. So obviously this is what you want to see, and I think that an interesting place to start. Merck is the first stock on this list. It's a global healthcare company offering prescription medicines, vaccines, biological therapies and animal health products. Now, healthcare is one of those industries which is always going to be needed, probably more and more, always developing, so I think it's one of those robust industries really. And they go into a few announcements on things that have happened to do with the stock recently here, which you can pause and read if you would like, but I want to skip to this part here. In the fiscal 2022 second quarter, Merck sales increased 28% year over year, which is fantastic, and their non-GAAP income grew 204.2% from the year ago quarter. Great numbers there, which you love to see. On July 26th, MRK declared the quarterly dividend of $0.69 per share, which will be paid out on October 7th. The company pays $2.76 per share dividend annually, which is a 3.18% yield, so a really nice yield. And the payout ratio, as you can see, 35.45%. I think that's nice and sustainable, and they've still got plenty of room for growth on top of that dividend yield, which is fantastic. And you can see their yield currently is higher than their 4-year average, but their 4-year average is also still very good, so that's what you want to see really. The company's dividend payouts have grown for 11 consecutive years. That's great. As it keeps growing and growing, then that's exactly what you want from your investments. Analysts expect Merck's revenue for the current year to come in at 58.6 billion, which is a 20.3% increase, which is fantastic. And then the company's EPS and dividends are expected to increase 22.5% and 8.4% year over year. So I would say great numbers all over, and they've topped the consensus EPS estimates in 3 out of the trailing 4 quarters. You can see it's gained 11.9% over the past year, which, considering how the market has fallen over the past year, that is really impressive, and I think has great signs for the long term. Merck's strong fundamentals are reflected in its power rating. The stock has an overall A rating, which equates to a strong buy in the trajectory, which is from Stock News, so they're suggesting strong buy. I'm going to go through some other sources as well, but yeah, strong buy from Stock News. I'd also like to show you tip ranks. You can see it's a 10 on the smart score, absolute perfect score. And if I just show you some analyst forecasts, 9 people recommend buy, 4 saying hold, and 0 saying sell, so that's great as well. And you can see the price estimates average out at $100, which would be a great return from the $87 it is right now, which is you can see there, average price of 14.19% change, which is, I say, great. And even the lowest price is still above where it is right now, so that's fantastic. Now, to show you a bit more information, I'm going to jump into my stock valuation sheet and why I think it's at a good value myself. So I want to jump over to my ultimate stock valuation sheet that I created and quickly put in Merck as the symbol and see how it performs on the ratings here. So going over to this, you can see the PE ratio is flying above a 57.86%. The fair value based on the P ratio, absolutely crazy compared to the current market price. But you can see it is underperforming on price to sales and price to cash flow, which brings the average fair value 2.62% above where we currently are. So it would still be a buy based on the average fair value, but these numbers are a bit too far apart, and we want to go into the manual input sheet and let's work out some of the numbers and try and make it look a bit better. So first of all, this P ratio fair value seems very high. Let's analyze why that could be. So the earnings growth rate, you can see 8.3%, Analyst 5-year estimate is 11.07% on, this will be the Yahoo Finance one, but let's have a look at what the analyst estimate is on here. So they're expecting it to go from 7.38 to 9.34 in 2025 on TradingView. So 9.34 in 2025 expected. You can see we're currently overshooting that a bit at 9.89. So I'd like to go for the more conservative of the two. Let's lower that to 7% potentially. That's going to take us to 9.5. Let's lower it a bit more, and that's going to take us to 9.4, tiny bit more. So 6% is underperforming this, but again, I usually like to go for half the analyst estimate. Now the analyst estimate on, this is really conservative, but the analyst estimate on Yahoo Finance was 11%. You can see to 9.34 in 2025. The estimate on TradingView is around that just over that 6% mark. So if we go really, really conservative, go 3.2%, I'd like to think that it will outperform that. But if we put in really low estimates, that's going to bring the P ratio fair value down to 108. And I'm very confident that that's fair for the P ratio. You could potentially lower this number, but 19 is really, really conservative again. We've seen it trade as high as 48 in 2018, 33 in 2017, over 20 in 2019 and 2021 as well. So it's quite a conservative P ratio already, but let's lower that to 17. I think that there gives us a 94 and a P ratio fair value in 2027, $161. Now that, I think, is a fantastic return, which I would be very, very happy with. So going really conservative on the P ratio, get a $94 fair value, $95 if you surround it properly. I think that's really strong, but let's look at the other ones. Why is the price to sales so far under? Well, it's using a 4 price to sales ratio. I don't think that's outrageous, so I'm happy to back that, but the revenue growth rate we have right now is pretty low at 1.39%. Let's have a look at what the estimate is. The estimate is to go from 58.56 billion to 63.42 billion. Currently, we're only going to 59.587, and we're going from a lower number. So let's put 58,560. Obviously, this is all in millions. So let's put this into the revenue. That's going to boost it a little bit. And for the price to sales, I'm happy to go with the estimates. And also, if we reference this here, as Merck is not in the launch stage, which is where the price to sales ratio is the most effective, we don't have to worry too much about the price to sales for MRK being we don't have to worry too much about the price to sales for MRK being under, as it's not the most important fair value. I'd say the PE and the price over cash flow are the two we want to keep an eye on, because both of those, the average of those, is usually where I like to aim more so. But if that price to sales ratio is also backing it, then that's what you like to see. So we can up this revenue a bit. I'm happy to go with the estimates to 63,420 for the revenue in 2025. So let's up this revenue growth rate a little bit to 2%. That's going to take us 62,000. We can still move it a bit higher. Can we go to 3? That's going to be 63,900. Slightly high, but not too different. Somewhere around 2.75 is probably the sweet spot. Yeah, that's around roughly. Obviously, this price to sales ratio fair value is still quite a bit under, but as I said, the price to sales fair value isn't the key one that we need to be focusing on, really. So I'm happy with the average fair value falling because of the price to sales. It would be a lot worse if it was falling because of the price over earnings or the price over cash flow based on the stage where it's at. Now, the price over cash flow, it can definitely be a lot higher than this. As you can see, operating cash flow 13,122, but that is 2021's number. So with that being 2021's number, let's have a look at where it is currently, because I know it's performing a lot better than that. You can see 18,890 million in trading 12 months, which is really, really impressive. As you can see, the funds from operations growing pretty heavily recently, and at 18,890 cash from operating activities in trailing 12 months, if we were to put that into the operating cash flow, 18,890, that's going to bring the price of a cash flow ratio fair value way up, 13.81% above. And also, I believe the cash flow growth rate usually outperforms earnings growth rate. Assuming the cash flow growth rate and earnings growth rate are fairly similar, but usually the cash flow growth rate slightly outperforms earning growth rate, let's go for 3.5% on the cash flow growth rate, and that's going to bring the price to cash flow ratio value, fair value, to $102, and that is a 2027 fair value of $173.7. So that's fantastic on the price to cash flow. Only really underperforming on the price to sales ratio. Now, although the price to sales ratio is a bit on the low side, once again, for the price over earnings ratio fair value and the price over cash flow ratio fair value to be performing well, they're the two that you want most importantly at this stage of a stock's life cycle. You can see price to earnings in maturity, and I like to have price to cash flow supplementing it, because often often net income can be skewed a bit based on accounting tricks, whereas the cash flow is harder to do that too. So I think taking the average of those two, that is really impressive, and this is with really low growth rates, 3% and 3.5%. I'd highly expect it to outperform those numbers, but even with those numbers, to have these fair values, that is fantastic. So let's have a look at the metrics long term. Putting in Merck as the ticker here, it's going to load in the metrics, and we need to input the 2022 values to get the calculations here. So 2022 equity, this is 2021, we can get to quarterly and we can have a look. So currently total equity is at 43,320 million, which is a very nice jump from the equity growth of 2021, which was at 33 billion or 33,000 million. So as you can see, after putting that in, the average yearly growth rates and a total CAGR on MRK's equity growth is not that great, but you can see it was falling 2015 to 2018 or 2019, sorry. It dropped massively from 46,000 to 27,000, but now it's starting to grow back, and it's growing back really quickly. If you were to look at the growth in just this period here, it would be completely different representation, and now that it is growing again, I think that's a good sign, and I'll be okay with the growth rate staying like this, as we can see higher growth in recent years. But let's have a look at the others. So EPS growth, we know that the EPS is expected to be 7.38 in 2022, so that will be great growth from last year in 5.14. That's going to be 40% average yearly growth and a 21.4% total CAGR. That is fantastic for MRK, and that makes things look a lot better. And with the equity growth also growing in recent years, I'm happy with the EPS growth. Operational cash flow growth, let's have a look at this year's again. We know 18,890. We're going to see that average yearly growth rate at 13.93%. So realistically, we're looking at, it goes green if we're looking above that 10% mark. That's what we're really looking for. And then these are our total averages at the bottom based on all of these. So let's put the last one in here. The last one, revenue growth, 2022. Revenue is expected to be 58,560. So let's put that in here. And that's going to be 6% average growth for revenue and 5% total CAGR. So slightly underperforming the 10% total CAGR we like to look for, but 15.25% on the average total, and it would be completely different if we were to work out the total CAGR and average yearly growth rates in recent years for the equity growth. So we can see they've really turned around their equity growth in recent years, falling from 46 billion to 27, but now back up to 43 billion, and it looks like it's climbing. So the equity growth in recent years has been fantastic. Let's have a look on the return on invested capital. Again, I like to look above 10% for this, and you can see statistics. their return on invested capital in recent years has been really strong. 12, 20, 8.69, 20.21, and then 25.75% in the current return on invested capital. 25% is absolutely fantastic, and they are very much overperforming that 10% on average since 2018. Did drop under slightly in 2020 when we're looking for that 10%, but that you can see that average is way over since 2018. And yeah, I'm really happy to put in a return on invested capital above 10, maybe at the 20 mark, as it seems to be around that as a median. So let's put 20% in on return on invested capital. And long-term debt versus the free cash flow. I like to see the free cash flow pay off the long-term debt within 3 years. If it can do that, then I'm confident that the company makes enough money for their long-term debt to not be a problem. So long-term debt, let's have a quick look. They are currently, we go total liabilities, non-current, long-term debt. They currently have 31,910 million in long-term debt owed, and their free cash flow is 14,400 million. So that is definitely going to pay off within 3 years. As you can see, this number's above 1, and 3 times their free cash flow is 43,200. So 3 times their free cash flow can pay off their long-term debt. So I'm confident that that is good enough to pay off, and they're not going to be in any trouble long-term with that. So based on these metrics, as the equity growth is really strong since 2019, the EPS growth has been fantastic long-term. The operational cash flow, again, it fell, but it's bounced back really, really impressively in recent years. And the revenue growth year on year is pretty steadily growing, and of a big jump in 2022. Those average performances coming in at 15% despite a big fall in both operational cash flow and equity growth amongst this. It wasn't by any means steady growth. Despite those falls, to come in at 15.25% average on the yearly growth rates and 7.71% total CAGR average. So one thing I'd like to quickly do is look at the total CAGR on what it would be if we were to do it from 2019, because obviously it's completely different and it tells a completely different story. Looking at it going from 46,000 in 2015 to 43,000 in 2022, obviously that's not impressive. But regarding the fall to 2019 and then the growth since then, you can see the CAGR would be at, if we change that to how many years? 3, 1, 2, 3, yep. And then if we were to change D2 to, we'll do H2, yeah, H2, you can see that total CAGR would then be 16% since 2019. Now that is really, really good, and that would bring the total CAGR above that 10% mark that I look for. So with the knowledge of that, I'm happy with the metrics, especially the return on invested capital. This was a key thing which I think really, really makes me support and trust the management, because they're investing well. And looking at the manual inputs, because both the price over earnings ratio fair value and the price over cash flow ratio fair value are both quite considerably above the current market price, I'm happy to go in. And even this average fair value, I'd be happy to go a bit above that, because I can stress again, the price to sales ratio fair value is more important in the early stages and is not so key in the growth stage. So if we were to alter this average fair value to just be the average of E26 and E28, then we would see it fall at 98, and I think that is a better fair value for me currently, considering MRK. This earnings growth and cash flow growth rates are really low at 3% and 3.5%. I think that is very, very achievable based on it being lower than even the half analyst growth rate and the realistic growth rate being 12.36%. So to achieve these numbers with such low estimates, I think is fantastic, and this is why I am buying Merck before the Ex Dividend date next week. Let me know if it's one you're interested in, and follow me on Twitter. I'll leave a link in the description. If you did enjoy the video, drop it a like and subscribe, and I'll try and keep up with you guys. But thanks a lot, and bye.